Hey everybody, this is Ben Kesnoka, co-founder and partner at Village Global, a network-driven venture firm. And this is our podcast, where we go deep on all things business and technology with world-leading experts.
Hello, everybody. I'm Olga Serhiyevich, and our guest today is Matt Pellini. Matt is a managing director in the Secondaries team at Hamilton Lane. Hamilton Lane is one of the largest fund of funds in the world and one of the largest alternative asset managers, with strategies from equity to credit, real assets, and everything in between. Secondaries have been such an important part of the conversation for the last couple of years that I thought it would be a good idea to talk to Matt a little bit about what he sees in the market. And so in today's conversation, we'll talk a little bit about market overall, what are the types of transactions that Hamilton Lane is seeing and working on, and then we'll talk about the current state of events and where the most interesting investable opportunities are.
Thanks, Olga. Thanks for having me. I'm excited to be here today.
Great. So first, let me ask you, tell us something about Hamilton Lane that people typically don't know. And another question is, where does the name Hamilton Lane come from?
So actually, the Hamilton Lane origin story is maybe a little bit less exciting than you'd hope for. My understanding is, of the two founders, their road names. One of them lives on Hamilton Lane and Hamilton, and then another one Lane, and so put it together, and that's how we got Hamilton Lane. So that's how the firm was named back in the day. And something we don't know is we're known as a large manager in private equity. We've been doing venture for 27 years, and so that's a very active part of our portfolio as well.
Okay, very cool. So let's jump into secondaries. Give us a little bit of an overview of the market overall, types of transactions, types of players, motivations. What does it all look like?
Yeah, so maybe starting a little bit of like, what are secondaries? Secondaries in this context within the private markets are when assets change hands between an asset that's already kind of been in play changes hand between groups. And so if you think about that in contrast to a primary investment is either in the context of a fund making a commitment to a new fund, or in the context of a company, basically a company raising new capital. And so in the secondary, it's either the trading of a limited partnership interest, or the trading of a secondhand piece of a company, or there's lots of different types of structured transactions in the secondaries. It can be different types of continuation vehicles or strip sales. And so secondary means different things to different peoples. It's become a very large part of the asset class. Last year alone, it was over $100 billion of secondary volume transacted.
How the market has evolved since the beginning, what are some of the things that changed, and what are some of the most active areas today?
Yeah, so maybe touching on that as well as what you mentioned, who participates. So in a secondary transaction, you normally have both the existing owner of the asset, who is the seller. You have the buyer, and then in limited partnership transactions, you have the general partner or the fund manager themselves. And so those are the key constituents. It's really changed over the years in terms of just becoming a much larger part of the asset class. And so I joined Hamilton Lane and really got my first taste of the secondary markets in 2010. At that point in time, the market size was around $20 billion. And so it's grown over fivefold since I joined about 15 years ago. Again, the types of transactions have also changed dramatically. When I first started, it was by and large just buying LP interest in funds. And so both the transaction size has increased, the amount of transaction types have increased, and the overall complexity of the transactions has increased meaningfully. I think another thing that's changed is really just and what's driven that is a few things. One is the overall NAV, or net asset value, in the asset class has grown. It continues to be a long-term asset class. And so if groups want to generate liquidity, before an asset is sold or before a fund is wound down, they really don't have many options other than to tap into the secondary market and find a buyer that can buy out their position. The sellers in this market have really changed their motivations over the years. So again, when I kind of first started, most of the sellers needed liquidity for some reason. A lot of them didn't actually love to transact in the secondary market because they viewed it as a sign of distress if an LP was signing, and they didn't want to be lumped into that classification. But I think as we look at the market today, most of the sellers are actually doing are transacting out of active portfolio management, and that could be there could be a number of different reasons that are behind that in terms of, okay, well, maybe we want to redeploy capital elsewhere, or we want to we want to cut off this relationship, or we just want to kind of manage our overall exposure a little bit differently, or there's a CIO change, lots of different reasons. But really what we found is sellers nowadays, similar to kind of how public fund managers manage their portfolios, private managers are taking a similar view and becoming more active in their overall management. The other change is the general partners themselves have become much more active in the market. And so they're actually using it both to manage their limited partnership base. So if you think about if an LP interest trades, you're losing one of your original limited partners, and who are you replacing that with? And so general partners are very cognizant of who they're replacing that with, and making sure that they're replacing it with an equal or more appealing long-term investor in their roster of LPs. Also, GPs are looking more and more into using the secondary market as their own means of liquidity. And so that both enables them to hold on to some of their marquee assets for longer than maybe what their fund life was set up for, and also participating as buyers on the secondary side in terms of some of these asset level transactions.
Yep. And what are you seeing now in terms of the pricing? And of course, it all depends on the vintage and the portfolio, but just overall, what happened sort of in the span of the last 12 months? How has the pricing evolved? And what are we talking about if, let's say, you are an LP that needs to generate liquidity with a fund that's like a 10-year fund, somewhere in the middle of the life? What should you expect? Sort of, where's the market today for pricing?
Yeah, so pricing ebbs and flows over time, and a lot of it takes cues from the public markets as well. And so, part of it is just the structural dynamic in which secondaries work. And so, if you think about public markets, assets are trading every single day. There's a daily price set at any point in time. There's price discovery out there. For private markets, typically the assets are marked on a quarterly basis by the general partners. And so in periods, so when you're buying a secondary limited partnership interest, you're buying off of a valuation in arrears. So right now, beginning of January, if we're looking at buying an LP interest, most likely that's going to be priced off of the September 30th, 2023 valuations. And so in periods where the public markets and the overall markets are functioning very strong, and there's uplifts, then a lot of times pricing gets stronger. And in periods of time where there's more volatility and more uncertainty, because again, we're kind of pricing off that arrears valuation and not today's valuation, there ends up being larger optical discounts. And so what we've seen was really pricing has been pretty strong over the longer term, over the past 5-7 years. In 2021, similar to kind of the public markets, it really tended to peak. Discounts were pretty thin. And then, going into 2023, maybe late 2022 and into 2023, discounts really widened. And so for buyout funds that were historically trading closer to 5 or 10% discounts, that probably widened to 15 to 20% discounts. And for venture, things that normally traded at, let's call it, historically venture is traded at larger discounts than buyout. And so maybe things were trading at 15%-ish discounts for a while. In 2022, 2023, that widened to closer to 30% plus discounts. And so pretty wide. As we sit today, some of that's worked through the system. The discounts have come down a little bit. So you're seeing buyout discounts probably in that 5 to 10% type range, and venture discounts still in the 30% type range.
Yeah. And my understanding is that a lot of the secondary funds are a different opportunity for LPs. And so their expected return is generally lower than, let's say, an early stage VC fund, right? And so if an LP is making that transaction where they're deciding to sell their LP stake, and then let's say you are stepping in, your expected return for that transaction is generally much lower than for somebody just entering into that or somebody investing in an early stage at the beginning. And so I've seen often very creative structures where the pricing is such that both sides can still be fine in the end, even if you are transacting at a deep discount. So talk us a little bit through some of the sort of non-vanilla pricing structures, and how do you manage relationships with all sides of these transactions to sort of be a good preferred partner by all sides.
Yeah, no, great. So maybe starting off with the return targets of secondaries relative to venture. Yes, I mean it's definitely lower than venture and more akin to buyout type investing within private equity. Secondaries is kind of viewed as a lower risk strategy within the private markets, and so and it's also focused on shorter duration. So secondary funds tend to focus a little bit more on IRR than end of day multiple, which is the opposite of venture, which is really about capturing that extreme upside and driving the multiple. That said, secondary targets are still normally within that private equity type return. So think of it as high teens or 20% type IRRs that they're targeting. And you're right. In today's market and market volatility, one of the biggest things is how to bridge the bid-ask spread between buyers and sellers. And so when I first joined the market again in 2010, my thought was, there's got to be this massive opportunity set. There's a lot of turmoil in the market. It would be a great time to be a buyer. While that was true, what I didn't appreciate was, actually, while it's a good time to be a buyer because prices are distressed, it's much harder to get deals done. And so the volume of deals tends to actually drop off meaningfully. Same thing with, say, early 2020 when COVID came around. Asset prices tanked and the secondary market pretty much froze. Price discovery at that point in time is very difficult. You don't have, a whole lot of visibility into how businesses are going to be impacted. And so buyers both kind of slow down and need bigger discounts. And then sellers don't want to take these massive discounts because even though they need liquidity, there's a threshold at which, they'll normally sell. So, oftentimes, like you said, structure can kind of feed into that and help bridge that. And so it can be anything from purchase price deferrals. So let's say that there's a seller that wants to sell something and get off its book, but they don't necessarily need the cash today. So in that scenario, you could offer something, okay, we'll pay you a certain price for it, but we don't actually have to pay you that cash until 6 months from now or a year from now, or maybe we pay you half of that today and half of that in a year from now. We actually did a transaction in 2023 that had a deferral that went out a little bit over 2 years, and so a very meaningful deferral period on that transaction. Another way is earnouts, and so similar. We did a transaction recently. The optical discount was fairly sizable, but we also wanted to make sure that we were being very fair to the seller, and so we structured it such that we get a certain amount of capital back first, and then beyond that, similar to a M&A type deal, if the fund assets perform that we're buying, we will share some of that upside with the seller, and so they can walk away not feeling like they sold for a below market price or that they gave away too much of the upside. So lots of different structures that can take place. But I say, yeah, two of the easier ones are purchase price deferrals and earnouts.
And when you look at opportunities to purchase an LP stake in a VC fund, are there any sort of biases or philosophies that maybe you have about that, where, let's say, do sector funds or specific sectors, do you assign higher discount to those opportunities, or sort of portfolio types, broad portfolios versus concentrated, or geography or something else? Or is it all really very asset dependent and it sort of all becomes very detailed analysis of the underlying portfolio?
Yeah, so look, when we underwrite, it's very asset dependent. We look at each of the underlying positions. There tends not to be a whole lot of industry focus or sector focus within secondaries, because while there are some sector focused PE funds, you would really be limiting the universe out there. So most of the funds, let's say, even if they're sector specialists, they may have 2 or 3 different verticals that they specialize in. And so if we build out a team of just healthcare experts, that would really dramatically limit the type of transactions that we could go after. And so most secondary funds tend to be generalist, and their specialization is in the secondary itself and the structure, and understanding how to underwrite these opportunities. There is more specialization between groups that invest in, say, venture or buyout or credit or real assets or infrastructure. So there are some specialized secondary funds that focus on those different areas. The larger groups tend to be more generalists in nature, and yes, again, kind of do that bottom up type underwriting.
Yeah. So let's talk about some of the considerations for LPs. Let's say, I'm a new CIO of an endowment. I come in, and the first thing I want to do is fire every manager that the old CIO hired. And I am going to do that through selling my existing portfolio. So I've got a bunch of stakes and a bunch of portfolios. How should I think about different types of intermediaries to do those transactions with, right? There's lots of different funds. They're your competitors. Sort of, what does competitive set look like? What are some of the questions I should be asking, and thinking through just beyond pricing?
Yeah. So look, I think first and foremost, if you're in that situation, you want to think through your GP relationships, right? It's difficult to restart relationships once you cut them off, especially with premier GPs. There's pockets of the market where LPs are selecting what funds they want to invest in, and then within that, there are some where those GPs are oversubscribed and can, select which LPs they want to work with. And so you want to be mindful of, if you are doing a secondary, how are you kind of going about that, and making sure that you have good dialogue with the GP. And that you involve them in that process, especially if it's a GP that you want to have a relationship with going forward. Most GPs at this point understand what the secondary market is and the need for liquidity. And so if you're open and honest with them, then there's normally a path to maintaining that type of relationship. In terms of, the secondary process and using intermediaries, look, we see a mix. I mean, secondaries can be very time consuming, and it can be pretty daunting for groups that have never done it before. There's the aspect of, what am I allowed to share in terms of information, right? As an LP in a fund, you're under confidentiality on those. And so you can't just kind of go and blast the GP's information and their reports to all types of buyers out there and see who gives you a price. You have to be very mindful of that confidentiality. And so it's good to either work with existing investors in those funds. And so, that's a big leg up that Hamilton Lane has, given the depth and the breadth of our relationships. A lot of times when we're speaking with LPs, LPs will just come to us and say, okay, we're in these 20 funds. We're interested in getting pricing, and we can do that using our own information without them having to share the information with us, and that can help with their own discovery process. It's also time consuming in terms of just the legal aspects and the negotiations and the deal execution. So that's where, again, depending on how sophisticated the limited partner is and really how big of a portfolio they're looking to sell, they may want to engage an intermediary. The intermediaries or brokers can help them both identify targeted buyers, more targeted buyer universe, and help them save time there. They help them with managing the information flows and the dialogue with general partners. And so oftentimes in larger portfolio transactions, they tend to be more time consuming. And so that's where intermediaries can really help out and leverage them to do a lot of the admin work and also manage the right type of process. I think what we see is a lot of LPs that may just be selling a one-off portfolio, or that may have done it before, or may have existing relationships with secondary buyers. They tend to sometimes manage those processes themselves, and definitely favor, again, kind of groups like Hamilton Lane, based off of both the relationship angle with the GP and knowing that they're handing off a high caliber limited partnership relationship to their GP, and that a lot of times the GPs appreciate that and favor that. And also in terms of their own information sharing, they don't have to spend as much time with a group like Hamilton Lane figuring out what information they need to share and going through the groundwork with the GPs to get those approvals and sharing that information.
And then let's talk about the GP side. Tell us a little bit about how GPs can be using secondary markets to manage liquidity of their own portfolios. What are some of the most common use cases, and what are some of the considerations within that? Right, like recently, there's been a lot of articles that are talking about continuation funds with varying degree of positive and or negative vibes. And so talk us through some of the considerations for GPs and what should they be aware of when it comes to these markets?
Yeah, so I mean, the GPs are now a significant portion of the secondary market, and that's really, started probably 7 or 8 years ago and really picked up over the past 4 and 5 years where GPs started to tap into the secondary markets. And I think the number one thing for them to keep in mind is the secondary market can be a very attractive solution for them. I think I mentioned at the beginning, it's a way for them to really retain some of their best assets for longer than what their fund life allows them to do, and avoid some of the conflicts of crossover fund investments and that type of stuff. That said, GPs really need to be upfront with their own LPs, with their limited partners about these types of transactions, and they need to really prioritize their limited partners' best interest when considering these transactions. So they need to talk to their limited partnership, their limited partners, or their advisory committees about these transactions, engage with them early on, get feedback from them in terms of their interest level for these, and just make sure that they're very transparent throughout the process, that they're sharing the same information with their existing limited partners as they are with the secondary buyers. There needs to be complete information symmetry in these transactions. The benefit for GPs is really to be able to, again, hold these assets, but also drive liquidity for their LPs. And so sometimes, getting later in the fund life, there may be assets that aren't quite ready to be sold. They could be, working on a second iteration of their value creation strategy. Or it could be something as simple as, well, we're coming back to market with a new fund, and a lot of LPs like to see distributions before they then double down on the manager and give them incremental capital for their next fund. And so it can be a way to basically replenish the coffer for their LPs and say, okay, we'll get you back some of your distributions. We'll do that at nice levels of return, and you can take that capital and redeploy it into our next fund, since we've given you favorable experiences. So there's lots of different reasons why GPs tap into the secondary market. And again, over the past couple of years, it's been and sometimes as much as 60% of the secondary market has been through these GP type transactions, which ends up being, there's still liquidity in there. We call them GP transactions because the GPs are involved with them and really orchestrate them, but they're still for the benefit of the LPs and driving liquidity for their LPs.
And why do continuation vehicles in particular get, a certain amount of criticism? Sort of what's the difference between utilizing these tools, as you said, to just manage liquidity for LPs, and obviously, venture in particular is a very long dated asset class, right? And so it makes sense that some GPs would be thinking about using these tools. So why is there some amount of criticism about it, and sort of how do you differentiate between some cases where there might be some negative signal around GPs using these transactions?
Yeah, so I mean, in GP continuation funds, essentially what the GP is doing is set up a new vehicle with a new set of LPs and transferring their assets from their old fund into this new fund. That price is often set by the secondary investors that are investing in that, and so the price is set by a third party. But typically, because the GPs are continuing to manage these same as they had been for their primary investors, they are getting management fees and some level of carried interest on it, and so there is an inherent conflict in terms of GPs kind of selling to themselves despite having the LPs set the new pricing, and that the GPs are collecting economics on this new vehicle. And so that's where sometimes these get a bad rap. And I think you really need to understand, again, what are the motivations of the GP for doing this type of transaction, and what is the desire from their existing LPs for this type of transaction. And so if a GP goes to their LPs and let's say they're in year 2 of their 10-year fund, and they go to their LPs and say, hey, we want to sell a bunch of these assets into a continuation fund, that may raise more eyebrows, right? The LPs would say, okay, well, why? We still have appetite to hold these for a couple more years. Why would we want to take them away from us and sell them to somebody else when there's more return to be made? On the flip side, and sometimes there's good reasons for that, right? One of the reasons may be, well, look, we're kind of maxed out on the amount of capital that we have here, and we want to. The strategy for these companies requires more capital, and so if we put this into a new vehicle and recapitalize it, we can put more capital into these companies and continue to support them in their growth efforts and really drive this forward. And by the way, as an existing investor, if you want to participate in that, you have the option to participate. Where you're more than welcome to retain your interest by participating in this. And so you need to make sure everything's kind of on the up and up. And so long as it is, we don't see that there's a whole lot of pushback on these. And also, on the flip side, funds that again are, 6, 7, 8 years old, that's where you oftentimes see the LPs looking to drive this, GPs to use this liquidity solution as well. And so they sometimes get a bad rap, but most of the times I think LPs are familiar with them enough that, again, if there's that level of transparency in the communication, then normally there's not a whole lot of aversion to it. I'd say one other thing to think about is if it's a situation where, we used to call these zombie funds or vampire funds, right? The funds are kind of, they haven't performed well. The GPs are still sucking off management fees. They are not in a carry position. And so then they're looking to basically reconstitute this fund so that they can get a higher management fee and get a second crack at carry. Those are the ones that tend to have a little bit more conflict and raise a little bit more eyebrows as well, because in those situations, the GPs really can end up much better off than if they just continue to manage out their existing fund. Again, there still may be reasons behind that, but you have to be very aware of those situations.
And let's switch to a couple of sort of higher level topics about the sector. What role does technology play in the secondaries? Both, maybe tech-enabled players, intermediaries, platforms, sort of what do you see? And then also, how do you use technology at Hamilton Lane to support your investing process? Where do you see most leverage from tech tools in private market investing in general?
Yeah, so I mean, obviously tech is popping up everywhere in every industry, and that's the same in private equity and secondaries. I think there's a couple components. One is in terms of the intermediaries, we're seeing a lot more brokers that are trying to use technology in terms of facilitating deal flow and increased transparency around buyers' price or sellers' pricing and buyer appetite for that. I think what we've seen on the tech side with intermediaries is it tends to be a good use for kind of disseminating information, but a lot of the transactions themselves, the negotiations and the actual execution of it still tends to be offline because, rightly or wrongly, there's still like paper intensive. The AML, KYC aspects of those are still, have not yet been largely digitized yet. And so, again, it's more of kind of the interface than the actual inner workings of the transaction. Now, there are groups, and we've put some capital behind this as well in terms of digitizing the transfer process and digitizing the AML and KYC process. And so that I expect that will continue to change and continue to evolve pretty rapidly. On the buyer side, everybody's talking about their technology and how they're using technology, and now even how they're using AI to help price secondaries and that type of stuff. Look, I think at the end of the day, technology is only as good as the data that you have behind it. That's great if you have a good tech platform, but if all you're grabbing is kind of either wrong data or publicly available data, then that doesn't really provide you with that much of an angle because anybody else can do that. So, at Hamilton Lane, we've been investing heavily in technology for quite some time now. For at least the past 10 years, I'd say we made a pretty big push into doing that, and that's really been able to, that's been an initiative of the broader business because we have so much data. It was a big need for us, right? We needed a better way to both collect that data, manage that data. And yes, as tech tools continue to kind of increase and get better, we're finding more efficient ways to actually use that data and process it. But again, I think technology is something that everybody's talking about today, but it's really, what's the strength of the data behind the technology that's important.
And given your global focus, tell us a little bit about geographical differences between, volumes of transactions. Maybe there are different types of terms. What do you see between different regions of the world in secondaries?
Yeah, so it tends to mimic the broader private market ecosystem, and so I think the majority of the private markets, the largest region within the private markets remains the U.S. And so naturally, more of the transaction volume involves U.S. funds and U.S. companies. Now, that said, there's still very active market outside the U.S. with Europe and with Asia and with rest of the world. And most secondary buyers like to build a diversified portfolio. And so even if you're located here in the U.S., you tend to do a little bit in both Europe and Asia and rest of the world as well. And so there's meaningful activity, and it tends to be global in nature. But yeah, I'd still say that 60+% of it tends to be here in the US in terms of what funds are transferring and what assets are transferring. There was a pretty big uplift in terms of Asia transactions a couple of years ago. Some of that has tapered off, given some of the geopolitical as well as some of the aspects of just investing in Asia, but that still continues to be a active market.
So that was going to be my next question. As maybe over the last 12 months or so, a number of large limited partners changed their positions and views on participating in China opportunities in both venture and private equity, just more broadly. And as they're thinking about restructuring their portfolios, are you seeing a lot of interest in selling LP stakes in China-focused funds?
Yeah, so I wouldn't say we've seen a large uplift. again, is probably commensurate with the overall size of China within private equity, which is pretty sizable. I think one dynamic that we've seen over in China is the local funds, the RMB funds, have become a bigger part of the the venture market over there, as opposed to the global venture players. And so within that, it is tougher for secondary funds to participate in secondaries in local RMB funds. You need to be, have an RMB fund set up in order to play in that area. We've actually been one of the few groups that have set that up. So we do have a RMB fund or RMB vehicle focused on secondaries, and so we can play into that market. But I think maybe there's been a little bit of an uplift in terms of seller appetite over in Asia, but not a dramatic amount. And I think part of it too is, the buyer appetite also needs to increase along with the seller appetite in order to actually see increases in volume. And I think today you're probably a little bit more constrained by buyer capital than you are by kind of the amount of sellers out there.
And let's finish this conversation on secondaries with sort of a broader question of how the development and growth of the secondaries market may impact private equity and venture capital as an asset class overall. And, I often reflect when we think about public markets, right? Primary issuance is such a tiny part of like what is happening in all the action. And of course, in private markets, that's a lot more difficult because of the transaction costs, because of the information access differences. So how do you think about the impact of the growing and active secondary market on the development of private equity as an asset class?
Yeah, so again, I mean, if you just look at the numbers, it proves this out. But it's a hugely important to the overall, private equity markets in terms of generating liquidities for LPs and GPs and letting them kind of recycle that capital and reinvest in the private markets. And I think that's only going to continue to grow in importance. And I think what's helping to facilitate that is better information across the asset class. Better education around what secondaries are. And so I think, really, if you look at the amount of deal volume that transacts within the private markets relative to the NAV, I mean, it's only a fraction of the amount of NAV out there. And so, I think what's really going to drive it is there's attractive returns to be had within the secondary market. And we're seeing, the longstanding players raising larger funds, and we're seeing some new entrants into the secondary market. And so I think that will continue to be a driver of the overall size. I think that the seller volume is there, the need for liquidity is already there and will continue. And but there's big barriers for entry. Again, the barriers for entry being the information needed to actually price and invest, and know, be able to do that in a educated way and do that in a institutional way, I think is very important. And then also just the relationships. It's very difficult to come in and buy a secondary in a fund when that fund manager doesn't know you. And so you do see some offshoots of secondary funds. Some of those are people that are experienced, but there's aspects of that there that present pretty high barriers to entry within the asset class. But overall, I expect it to continue to grow and be a big part of the asset class.
And I'd like to finish these conversations on a more of a personal topic because we all are humans and we do things outside of work. So what is something outside of work that you know a lot about and are passionate about?
Yeah. Well, look, a lot. I have 4 kids. I'm married and have 4 kids. So a lot of my time is spent with the family and doing different things. I love to get them out and about, but I grew up surfing, and so surfing is a big thing that I love to do. I'm getting my kids into it, and I've traveled around the world surfing different spots, and so I think one thing that probably surprises people is if you show me a picture of a wave, there's a good chance just by looking at it, I can tell you where it is and tell you a lot of facts about that. And most people probably just look at a wave and say, "Oh, that's a wave." But yeah, I think most surfers probably understand what I'm saying here, and that's something I'm definitely passionate about and love to do in my spare time.
That's a really cool superpower. Well, Ned, thank you so much for walking us through the secondaries as a sector and sharing your expertise. And perhaps next time we'll discuss waves.
Perfect. Thank you, Olga.
Thanks so much for listening to the Village Global podcast. You can check us out online at villageglobal.vc. We'd love to hear from you, your feedback, your ideas, your inspirations. You can email us at hello@villageglobal.vc.